everybody. Welcome to another Talk Money with Tom show. Really glad that you could come today. Our objective is to try to help you have a better financial retirement. And we do that through answering questions, actually. So if you want to send in your questions, you can send them to asktom@talkmoneywithtom.com. Send them now, and we'll try to answer them live on the show. You can put them into the chat, and we'll answer those live. You can send the questions in during the week if you want to give us some time to take a look at it. And we always cover questions that come up in the strategy sessions from the clients. And so really interested in trying to help you here as much as we possibly can. And we believe that the more that you understand about how to manage money and how to plan retirement financially at least, and then how to reduce your taxes during retirement, regardless of whether you're 20 looking forward to retirement or already in your retirement, these things are things that you can start to learn and start to get a better understanding for. And so we have this Talk Money with Tom channel. Go ahead and peruse the different videos that we have here. If you like it, you can subscribe to the channel. You hit the little subscribe button. If you want to get notified of additional videos that we're putting on, you can hit the little bell button next to that. And then I think the last thing, if you're interested in talking to Easton and I, you go to our website. There's a link right here on the channel. There's a book appointment button up in the corner. It looks just like this. And set up a 30-minute phone or video call, and we'll sit down with you and talk to you about your specific needs as far as that goes. So I'm hoping everybody can get something really useful out of today's show, and look forward to answer your questions. Start sending them in now, and we'll be able to answer them here live on the show. I do always like to start off the show with the summary of what I saw happening in the stock market this week. And what you're seeing here, of course, is the S&P 500 for the year so far. You can see that blue line is the 200-day moving average. Some very significant things have happened this week, actually. The first one of which, of course, is the scenario where we've had 2 days down, Monday and, oops, here we go, got some technical difficulties, bear with us.
Share now.
I always like to start off the week, of course, with a summary of what happened with the stock market. So you can see the S&P 500 here so far this year, this really amazing run we've had since the middle of June where we hit a bottom. We dropped 24% from the high to the low. The blue line there is the 200-day moving average. We're starting to get closer to that. What happened this week was the first couple of days we were down, and then Wednesday we had the CPI report for inflation. It came out lower than expected. Market jumped, and really important jump, because if you look closely at this, there was 8 days back in June and 8 days that ended this Tuesday where the market was basically just hitting the same barrier over and over. And that was the highest resistance level that we have for the S&P 500 over the last 2 years. And so when the number came out lower, it jumped over that. And so that now becomes support. So it's fairly significant support. And then yesterday, the market, Wednesday, the market's up a lot. So then you worry, is it going to give it all back? And Thursday, the market came down just barely, basically sideways. That's perfect. That's exactly what you kind of want to see. And then today, it's roaring off. And we're going through some other barriers here on the way up that are really important. We're still trying to determine for sure if this is the reversal and we're going back up to better days and higher highs, or if this is just sort of a fake bear market rally, they call it, where we go back to another low. So there are a couple things coming up here that are going to be important to watch. So first of all, draw this little yellow line here. This yellow line shows a 50% retracement of the loss. So in other words, we hit a high in January, a low in mid-June, and now we're just above today that 50% retracement. So we've come 50% back. There have been a couple articles out. Bloomberg's had one, Market Watch, and what they're saying is that a bear market, which is when the market goes down 20% or more, and that's what we have here, and once it retraces halfway and closes above that, so today it would have to close above that, so we'll see what happens, but it looks good. It's moving very strongly as we speak. If it closes above that, it has never had a situation where the market went back to establish a new low. Doesn't mean the market won't go back down some, we'll have some volatility or what have you, but that's super significant because that's what we're trying to determine here. Was June the low? And we're kind of out of the woods as far as that goes, and maybe we have some volatility, but eventually, things do start to come around or not. So that's a very interesting stat, and we'll see how that plays out as far as that goes. And then the next thing that we have coming up is that blue line there that you see is the 200-day moving average. That's a really big indicator for a lot of traders when the stock market jumps through, above that 200-day moving average. Oftentimes they look at that as a reversal of trend. So that's our next, barrier that we're looking at. It's not that far from where we are right now. Really, it's about 43.30 on the S&P 500. We're at about 42.60 right now, as we speak. So not far from that. We'll see how that works. And then the next one, I drew in a trend line here, just kind of connecting the top point that we had in March, end of March, and the top point, for the all-time top point for the market back in January. And you can see that actually is kind of converging with the 200-day moving average. And so those are like check boxes. We get through this big barrier we just got through on Wednesday. Good. That becomes support. Hey, we close above this 50% retracement. Good. Market's never retraced to a new low before in a bear market, so that's good to hear. We get through the 200-day moving average, get through the trend line. I mean, we are definitely having some potential there for a reversal trend completely and start to move back in the right direction. So that's why on Wednesday when the inflation number came out, we removed all of our treasury positions and moved back into our full normal allocation. If somebody had a 60% exposure to stocks, we had reduced that for a while here just because the yield curve inverted, the leading indicators peaked out, and those types of things, which can be indicators of problems for the stock market. They can sometimes be early, so we'll see what happens coming up later. But now that we've broken through all these barriers on the upside, it's time to get back into the full exposure. And so we're back into, if you have a 60% position, we've moved back into that position. So, so far so good as far as that goes. And really the main catalyst, of course, this week was the CPI number, the Consumer Price Index. This is what most people are familiar with. And this is the last to drop to 8.5%. And this is a basket of goods that they look at to determine, how much they grew versus last year. So July of last year versus July of this year. And the other thing that people are looking at that they're kind of excited about is the fact that a lot of these leading indicators for inflation, commodity prices, have been coming down. A little bit of move up later on in this week, so we'll see how that plays out. But that those things like gas and such that have been coming down, and so that's sort of making people feel better. Core inflation, where you take out food and energy, basically held the same, which was better than expected. They thought it would go up, right? So that's good as far as that goes. But you have to understand that the key driver here is really kind of energy, because energy itself is a category. It is in that top line inflation number of 8.5%, but it's also in everything we do. If you go to the restaurant, they're having to pay for higher energy costs to get food delivered, wholesale food delivered, and those types of things. Target talked about, in their last earning report, having $1 billion more transportation costs because of the increased cost of gas and diesel. And so obviously, that might translate to higher cost at Target, right? So it's everywhere. And so that's one of the main key pieces. Today we saw another kind of interesting move, and this is the Consumer Sentiment Survey. which just 2 months ago hit an all-time low. This goes back to 1960. And now we've had a couple of months in a row of increase. It's still pretty low, but the consumer is starting to answer the question of how they feel about their finances and how they feel about the business situation here in the U.S. in a more positive manner. And that's a leading indicator for spending, and which is a leading indicator, obviously, ultimately for the stock market and the economy doing better. So that was another thing that's kind of driving the market today. But here's the key, in my opinion. If you want to follow one thing and really understand kind of what's going on, look at gas prices. Because what's happening with gas price, we'd hit a little bit below $4 a gallon nationwide this week. And the lower gas prices have gone, the more the stock market's gone up. That's it. If you want to follow one thing, and I mentioned this months ago, talking about gas, because it incorporates what's happening in Ukraine. It incorporates what's happening with refineries, which have been shut down, during the pandemic, and whether they're going to be able to deliver more, gas. And it is in everything. Almost everything that you do or use. You've got your own transportation. All of us think about, going to the pump. Look at the consumer sentiment survey. It has gone up as gas prices have gone down. And when it hit its high point, there is the point in the survey that hit the lowest point in history, right? So definitely a sensitive issue for consumers. 2/3 of the economy is consumers. And so their thought process and how much money they have to feel they can spend has a lot to do with gas prices. And of course, the actual cost of all of these goods has to do with gas prices. So it's still really high. And this is just a short-term chart here. But this is probably, if you look closely, obviously the biggest downturn in the price we've had so far in this time frame. And it looks pretty strong. It's kind of moving down. So, we'll have to watch. But this is the one thing to watch. If you see gas prices shooting back up for some reason, and there's lots of reasons it could. For example, really, in the situation in Ukraine and Russia are probably the one that comes to mind the most, then the market's going to struggle maybe in that time frame. So, so far, gas prices are going the right direction. I'm really very excited about that. So altogether, a pretty good week, actually, a really good week, very significant, broke through some barriers. We moved back into full allocation. We got some barriers ahead of us, but it is moving very strongly, right, I think, up to those barriers. So pay attention for the next week or two. We'll see what happens with those barriers that are above us, and we'll watch those gas prices and see what happens. So very, very interesting week altogether. So look forward to being able to kind of discuss what happens next week at the next show. Thank you. All right, Ethan, let's start off with some questions.
So what goes into the CPI number?
The CPI. So CPI, of course, is Consumer Price Index. This is the big number that they use to determine inflation. There are lots of different inflation measures. There's PPI, Producer Price Index, which is wholesale inflation. There's PCE, Personal Consumption Expenditure, which is the one the Fed likes the most. But CPI is the one everybody knows the most about, right? Mm-hmm. So, what is it? How does it, what's it made up? And basically, it's a basket of goods they're looking at. And they're looking at, how much did it increase month over month, so versus last month. And the most common number that people know is how much it increased year over year. Mm-hmm. So July of this year versus July of last year. So I do have a visual we can show that kind of breaks this down. This comes from the Pew Research Center. And you look, a third of it is shelter. Mm-hmm. So shelter is a big category. This is homes, rent, even, hotel stays, all these different types of things. And then food is another big component, right? Almost 14% for food, transportation commodities, and energy, mm-hmm. and medical services, right? Those are those are the biggies. Education fits in there, transportation services, and then all of these little things. So like a lot of times we think about, apparel and those types of things, and really, that's only 3% of this basket. Mm-hmm. So if you're spending more on clothes, it's not going to have as big an impact on CPI as people. So if you look at this closely, it's very fascinating. Some of these are interrelated. The cost of energy goes up. Mm-hmm. That makes the cost of food go up. makes the transportation services go up, right? It could make everything on there more expensive. The cost of shelter goes up. That's why, like, if you go someplace where rents are low, both commercial and personal rents, oftentimes you go to that restaurant, it's a lot cheaper, right? My in-laws live in Wichita, Kansas. I go out to eat there. I'm always kind of surprised at how much cheaper it is than here. But if you look at what they're paying for housing, rent, commercial rent, all those things, it's a lot less. And so that can filter through to food. And so anyway, it's kind of fascinating to see some of the interrelationships on this thing.
Yeah, and so some things to also take in mind is that the CPI number, they like to also do substitution. And so say you have apples and bananas, but apples went up 4% and bananas went up 3%. They're going to use bananas for their number. So they're going to try and take, like what is the lower number. So because they feel bananas and apples, if you had a choice, one's more expensive, you're going to pick the other one. They're kind of the same for a consumer.
I tell you what, my wife wouldn't agree with that. She doesn't like bananas, but nonetheless, but it is interesting. And actually, the CPI number has been somewhat controversial over the years, just because it really does depend on how you spend money.
Yeah.
Right. I mean, how does it impact you? I mean, I was just talking to a client yesterday, and she says, I don't drive that much anymore. I have a few things that I'm doing, but I'm retired now, so the price of gas doesn't. I don't care. Now, it is costing her more for other things that she might be buying because somebody's having to drive to get her food to the grocery store, whatever it might be. She did say that the grocery store cost had gone up quite a bit, and she noticed that. But and so we actually found some really interesting charts that kind of break down, like based on your age, where people are spending their money. And so it sort of shows, like this is from the Bureau of Labor Statistics. This is a 52-year-old. And where they average spend their money. This is kind of hard to read.
Yeah.
So we'll just give you the generic concept here because it is kind of fascinating. They got a huge amount of money for their home. I can sympathize with that. There's a pretty good slice, that white slice down here in healthcare, and then that dark one up there is gas.
Yeah.
Right? So and actually all of those pieces are kind of energy related that are in that one section of that circle. Now if I move down to somebody a little bit older here, you can see how things shift. So here's a 67-year-old. If I go back and forth between those 52, 67, healthcare got bigger.
Yeah,
right?
and your transportation costs and your gas one also got smaller.
They got smaller, right? So again, depends on where that inflation is and where it's really hitting as far as that goes. And then let's go one age older here. We have a 76-year-old. Healthcare got even larger. And so if you watch that white one, you can see it shrinks based on age or grows based on older age. Watch the gasoline. It goes down, right? Which makes sense, right? You're not driving off to work and those types of things. And so, but the component of home ownership and the cost of home ownership, and that's where mortgage rates come into play for in fact affecting the overall the cost of living. The rent is another one too. So those are big, and so the CPI is trying to match one basket to a variety of people, and so your personal inflation might be different as far as that goes, depending on what you're doing. If you're driving a lot of miles and gas went from $2.85 to $5.85 or something, because a lot of times people are commuting into the valley to take a job. Sometimes those aren't high-paying jobs, and they can't afford to live here in the valley, so that's really tough because now you're using tons of money to kind of get back and forth to work. So it really changes the dynamics as far as that goes. But yeah.
Yeah, we'll throw the link for this article into the description, the replay, so you can go and play with it, because you can hover on each of these kind of categories and it'll show you kind of like the differences, and also with the numbers. So it's a lot of fun to play with.
Yeah, this is very fascinating actually, because you can see how much people are spending on restaurants and what they call full service meals and all of these things. So I think it's an interesting study as far as that goes. All right, what's our next question?
So how do you prioritize goals in retirement, like not running out of money versus enjoying my retirement and spending my money too? So how do you prioritize that?
how do you prioritize goals of not running out of money versus what I'm going to spend today, right? So I guess one of the things that I really think about all the time, and this is where planning comes in for me, is I want to know what I can spend today and not be broke tomorrow, right? I mean, that's kind of, what can I spend today without really damaging my future? And that's critical. I mean, I don't understand half the times when somebody doesn't have a plan in place, how you figure that out. You're just kind of guessing, and you could be right, you could be underestimating, maybe you could spend more, right? That's kind of interesting. Or you could be overestimating, and you're actually going to run out of money before you run out of time. So the one way that we always do that is basically through this Monte Carlo simulation. So I do have one I can share with you here. And so, of course, with Monte Carlo simulation, we can say, okay, what amount of spending is going to make you run out of money, and what amount of spending is most likely not going to make you run out of money? And then you've got a dollar amount. Now I got a budget. And so let's say it's X dollars. I can take that and I can go out and say, okay, I can spend that, any way I want. Maybe I'm spending too much over here. I'm going to try to cut that back so I can spend some more on travel or, whatever it is. But now I have a budget, and I know, hey, I can take a $10,000 trip, or I can't take a $10,000 trip, or, whatever it is. I'd like to know. Now, there are some people that have so much money it doesn't matter, right?
Yeah.
And it's just like, okay, but we're talking about the average, client that we deal with. They've got a certain amount that they can spend and make it work. And it's really, really useful to know what that is. And so when we do Monte Carlo simulation, inside this financial plan, we'll have all of your outside incomes that are coming in. Social Security, rents, pensions, those types of things. And then we'll have all of your assets listed, right? And how they're broken down, stock, bond, cash, that type of thing. And then how much you're going to spend on all these things. So here's our first foray. We're going to look at this, see if this works. We're going to spend X amount on basic retirement expenses, and then, medical, maybe dental, hearing aids, travel, car replacement, home repairs, breaking out into these subjects. Okay, now we've got all that in there. That's our outflow. Does it work? Well, we basically then go to Monte Carlo simulation, and the computer will run through the plan 1,000 times based on incomes, assets, and outflows that we just put in there, and see, is it going to work? So, when we run it, we go up, push the button, and here it goes. Okay, so that parameters that we put in there came out at 48%, basically probably not high enough. I mean, if you didn't live very long, it probably works, but that's one of the problems is we don't know how long we're going to live. We do have to plan financially, in my opinion, for some longevity, because that's the problem. Okay, I'm only going to live to 80. Well, and I'm going to run out of money at 80. Okay, fine, but then all of a sudden you're 85 or 90. What do you do? So that's where, there's some interesting issues on what ages to pick and those types of things. So we go back to the drawing board.
Yeah, this
right?
is where we start to downsize goals or something like that. Say,
Yeah.
I have a travel budget of $15,000 a year.
Right.
Maybe we have to cut that back to $5,000 a year.
Right, and so we look at the different aspects of where we can, kind of move things around, and then we come back and we say, okay, we just kind of push the button again after we made these adjustments, and okay, great. Look at this one here. We got a 96% probability of success. Okay, so that number, whatever it is, so maybe you can spend more than 5. If we just went from 15 to 5 on travel, maybe you can go back to 10. So, because one of the things for me, if somebody's trying to really maximize what they can spend today, I want to keep that number at around 85%. And then if I run this every 6 months, I can tell if things are off or not pretty quickly, and maybe we make adjustments. But I could tell somebody, okay, at 85%, here's your overall budget, for your all these things, travel, medical, home repairs, all these things. And that's going to work, right? And go spend that. And then, 6 months later, we do it again. And we take a look, and and all of a sudden we shoot backwards to 75. Maybe we need to adjust. Or if it starts to grow, up to 90 again, maybe we can spend more. So that's how we do it. And so to answer the question, you really want to prioritize not running out of money versus, what the enjoyment that you might get out of today. because running out of money will take away all of your joy.
That is true.
So, so anyway, that's the process that we use. And I think it's, again, knowing what you can do today that won't damage your future allows you to have so much more fun today, because you know exactly, I can afford this trip. It might even be more than I thought I could afford, but I'm looking at this, I'm run 1,000 scenarios, and I can afford this trip. And when you're on that trip, you're pretty happy. Instead of having this thing in the back of your head, can I afford this trip? Can I afford this car? Can I afford to lend this money to my kids? Whatever it is that's coming up, I think it's critical to know the answer to that, at least as much as you can know. Helps.
Yeah, and the nice thing about these goals is, like, maybe you want to change your goals in the sense that I want to retire a little bit earlier. Could we do that? And so how do we prioritize, those ages versus having enough income to do your lifestyle?
Yep.
And so you can do a lot of play with that.
Yeah, that's right. All kinds of scenarios that we can run through to try out and see what works and what doesn't work. And I think it's, quite useful as far as that goes. So that's good. All right. What's the next question?
So why is it better to pull from a non-retirement taxable account than a IRA, so an individual retirement account?
Okay, so let's assume what we call the buckets of money, right? And we got as taxable accounts. People call them individual accounts, brokerage accounts, TOD accounts, trust accounts, right? A lot of different names. But basically, in that taxable account, when you make changes, you have to report them on your tax return. They could be taxable, pays dividend or interest, that ends up in your tax return. An IRA, on the other hand, you only pay taxes on it when you withdraw. You can make changes without having to report them. Dividends and interest are deferred until later. You basically only pay when you withdraw. And so one of the things that you have to figure out is, where do I get my money from? What is the sequence of withdrawals? Where do I go first? Where do I go next? And where do I go after that, right? So really, it should be take money from taxable accounts first, tax-deferred accounts like an IRA, 401k second, and tax-free accounts like a Roth last. So when we go through that lineage, though, there are some criteria and some things to think about. That's the simple version and answer. But you don't particularly want to run all of your taxable accounts, because that would include your bank accounts, your checking savings, to zero before you start going to your IRA, because you are going to have some need for an emergency buffer. So you kind of say, okay, I'm not going to go below that, right? And so I'll make this up. Let's say I've got $100,000 and of total assets in taxable accounts. I don't want to get below 50. At 50, I'm okay, but below that, I get nervous. So that means I can spend the other 50 first, right? And the reason that you go to the taxable accounts first is because of taxation. The capital gains tax, if held on for more than a year, is lower than ordinary income tax, right? So that's great. And there's a chance that some of the money you have in there, you've already paid taxes on. So when you pull that out, it's essentially tax-free.
Yeah, right? Returning of your capital is always tax-free.
Right. Because you only get taxed once in that scenario. So whereas when you withdraw from that IRA, it is every nickel, for most part, unless there's some weird things going on with after-tax dollars. But for most people, it's all tax deferred. And when they pull money out, the whole amount that they pull out is taxable. And it's taxable at ordinary income rates, which are higher than long-term capital gain rates, right?
Yeah.
So that's the main issue as far as that goes, in terms of where to pull the money from, kind of first, second, or third. And that's why we look at that. The other criteria, though, that I would say, besides having an amount for an emergency buffer that you don't want to run below, sometimes people have some really good assets in those taxable accounts that are doing fantastic. And so let's say you worked at some company and it's just going and going and going and going, right? And, should you really be running that down to zero just because of taxation, giving up this fortune that you could have if it continued to grow like that? There is a certain amount that you should be careful of letting something like that dominate your life, because any company can fall apart. GE fell 90% from high to low. If that can happen to GE, really, it can happen to any company at some point in time. You have to be a little bit careful. But I would be much more in tune with trying to keep a majority of that and maybe just kind of pruning little bits and pieces off. And so let's just say, for example, I've got $1 million in this taxable, of which 900,000 is this one stock, and it's doing great. And it's a good company. It's really solid. The market seems to like it in general. It does better than the market over time. And so I'm going to be looking at my IRAs sooner than I would, even though I have a lot of money in the taxable, because I'm not making as much money in my IRAs potentially as I am here. You can do some different things. If you really love that stock, you could sell some, here to live off of, buy some back in your IRA. You can kind of keep some of that same exposure that way. But generally speaking, we don't do that. It's just a matter of, now, do I want that to become $5 million? Or, is there some number where it gets too big? So and maybe I'm going to prune on that once it gets to that number. So that's the overall thought process with kind of taking money out of a taxable account versus an IRA account. We start with the taxable account. There are some caveats as to how far we go with that, but that's where you want to start, and it works. It makes a lot of sense once you really think about it.
So, should I be looking when planning for retirement to be replacing my income, or should I be looking to cover my current expenses? How should I be planning? Am I looking to say I have $84,000 of income? Should I be looking to replace 80% of that, or I only need $4,000 a month to live? Should I just be looking to cover that much?
Yeah, so I'll use different numbers, but so the thing that comes to mind, I've got $100,000 worth of income after tax, let's say, and I'm living off of $80,000, right? Should I be covering the $100,000 or the $80,000 in terms of my planning process? Well, where's the other 20 going? It's going into some kind of savings, most likely.
Yeah.
Maybe it's going into your 401k and those types of things. It's still a good idea to try to save if you can in retirement, but usually it's not coming from this outside source. But some people have a lot of outside sources, big rents and things, but for the normal scenario. And so really I think covering expenses is really what you're looking at there, more than kind of replacing your income. They can be kind of close because, one thing I've run across that I think is a bit of a myth. A lot of people look at retirement and say, "Oh, I'm going to have, I'm going to spend a lot less money in retirement," just because, I'm going to be more conservative. I've not seen this happen. One thing that does go down is the amount of savings. So there's no 401k contributions going on anymore. So that's a savings, but that's, not an issue. And then the second thing that, clothes and gas, and we actually saw, as you look through CPI numbers for different ages, you can see where kind of money goes into different directions depending on age. And having said that, age, we saw some increases based on age. Healthcare grew, travel would grow in theory in retirement. So I think you want to identify, the expenses in retirement, and then try to see if you have enough assets and outside incomes to cover those expenses. Using Monte Carlo simulation to determine whether or not that's going to be possible.
Yeah, because you might be cutting some expenses, but other expenses go up. Let's say you're an avid golfer. You're instead of hitting the course only on the weekends, you're going to probably be hitting it on the weekdays now too. And so there's other costs that just with that extra time that you have now, they're going to increase. Yeah,
I've had lots of golfer clients. They golf every day, 6 days a week. They just, that's what they do. They get up and, go golf. And they've got a social network there. They've got, some exercise. And it's, so exactly right. And so there'll be some more money spent on some of these things that you're not spending on now as far as that goes. But, yeah, I think, identifying up front, it depends on where you are, right? If you're in retirement, that's a different scenario. You've already got some idea what your expenses are. If you're not in retirement, then you kind of want to project what those expenses are going to be. We put that into the plan, and then we really look very closely for the first couple of years in retirement to see, hey, is this actually right? Are we spending a lot more or less? Or, what is going on as far as that goes? And being able to just kind of get that expenses covered in the most tax efficient manner, and taking from the assets that have the least long-term impact to you. So, You don't want to sell your great things to try to live off those expenses if you can avoid it. Hopefully everything you have is great. That'd be perfect. But it doesn't always work that way. But yeah, that's a good question.
So, can you explain how a reverse mortgage works?
Wow. So a reverse mortgage is where some mortgage company, pays you for the value in your home, and instead of you paying for the mortgage. And so this is a methodology that gets used. I've not seen it a lot, but a few times, where people will basically, they don't want to sell their home. Maybe it's got a big capital gain. Maybe it's got sentimental value. Maybe they got a lot of friends. They just don't want to deal with it. Maybe they need the money, right? They don't have other places. In my opinion, the reverse mortgage would be, one of the last places you'd probably go after you've kind of exhausted a lot of your other, assets, at least a majority of them. And so what happens is, this is assuming you have equity in your home.
Yep.
You go to some place and get a reverse mortgage, and they start paying you. Different ways that you can get paid. And actually, I remember you had some information on this, kind of the different methodologies.
Yeah, so for reverse mortgages, they're usually only for people 62 and older. So it's a very limited people that can do it. And so there's some different ways. You can do a term, so like I want 10 years of payments, or you can have it for the rest of your life, kind of like an annuity. And so with the annuity payment, it can go to the point where the bank is actually underwater on the house. So they've given you more money than your house is worth. At that point, when they sell the house, they just recoup some of the cost, but not all the cost. But say your house is still worth, $1 million, but your loan's only 500,000, and you were to sell, you would basically get the net of the two. So you'd repay your loan, and then the net would go to you or your beneficiaries.
Yeah, originally when reverse mortgages first came out, they were really, really sketchy, actually, because what would happen was that, you would sign up for this deal where you would maybe get a lifetime income, but then the person passes away fairly early. There's not that much that's been paid out, and the mortgage company got the house. So imagine, $1 million house, they pay out $50,000 in this reverse mortgage and pass away. Kids think they're going to get $1 million house and a $50,000 debt. They get no house. Okay, so that's changed now. And so now the debt is due, but that's true with any mortgage, right? And so either, the estate has some money to pay off the mortgage and then the kids can keep the house, or the house is sold and then the mortgage is paid off. And so that's no different than any type of mortgage, a first, second mortgage that we might normally have. There's just different ways of getting that income, lump sum, monthly, rest of your life, term certain. There's a whole bunch of different ways that that's going as far as that goes. Again, accumulating debt on your home should be if not a last-ditch thing, close to it. So it's not something that we see very often. We certainly haven't had very many situations where we recommended it either. A lot of people, what they're doing, actually, because we have clients all over the U.S. now and all over California, is instead of getting a reverse mortgage, they're actually just selling their home and buying something else in a cheaper area, and then they take that differential to kind of then start living off of, as far as that goes. That is most common. And people are doing that instead of doing a reverse mortgage. There are some disadvantages. You got to move. That's a hassle. There's a cost to moving. There's also the capital gains that you might have on the sale of that home. So that's where reverse mortgage comes in. You wouldn't have to sell and pay that capital gains. Maybe, mom or dad end up in a nursing home. That reverse mortgage could be used to,
Pay for that
nursing or part of it or what have you too. So there, it's that way the kids don't have to sell. And then if mom or dad pass away, the cost basis on the property goes up to current value. And even though mom and dad paid a lot less, the kids, if they have to sell it at that point, don't have the tax. So that's a scenario where I think you could make an argument for it. Just depends on what the costs are and how it works. But those are the things that are happening as far as that goes.
So you've talked about how the market's kind of broken this threshold. Where should I be looking to invest if I'm trying to come back into the market?
Yeah, there's been several articles over the last couple of weeks that people are coming back. They're all running. We've had, billions of dollars come out of money markets back into the market. And we did the same thing. We had a lot of treasuries just putting on the sidelines, just trying to be careful. We've reinvested that back into our pieces. So generally speaking, in a market like this, where the market has broken through some barriers, still has some other barriers above it to go through, but let's just say it keeps running. Where is the money going to be made? One of the first places I would make sure that I have filled out, and this is what we just did with our clients this week, is the kind of the total stock market index. We use the Vanguard total stock market index, ETF. The ticker symbol is VTI. You want to have a good exposure to that because that's all stocks on the U.S. market, and because then you don't have to worry about whether it's large cap or small cap that's running, micro caps. You don't really have to worry that much about what industry it is. Is it energy? Is it whatever it might be? And that index is pretty hard to beat. Matter of fact, here's a stat that's very fascinating to me. We ran through a little over 3,400 ETFs. We just did a study, and if you look back at how many ETFs have beaten VTI, okay, for the last 2 years and the last 1 year and the last 6 months and the last 3 months. Those 4 data points. So basically consistently beaten VTI. You'd be surprised, only 4.9% of the ETFs that are out there beat VTI over those 4 time frames altogether. That's really low. Now, there are some that did a lot better. They're just more volatile. Maybe they did terrible for 6 months and did great, and they're higher. I'm not talking about like total rate of return. If you're looking for consistency of rate of return, trying to beat what I call the market, I call VTI the market personally. That's hard to do. So start with something like VTI, and buy it, fill it out. We go up to 26% in VTI on our all stock portfolio. So I think that's a good place to start. The next place I really like is this S&P 500. So again, kind of stepping down a little bit more narrow. The S&P 500 is mostly large cap, some mid cap, but it's a very popular index around the world. And the U.S. market is going bananas right now, and money is going to be coming in. Believe me, this is going to be an attraction from around the world. Europe is struggling with the exposure to Ukraine. Whatever money might have been going to Europe might be coming to the U.S., right? And so boom, 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 you start getting these cycles of money coming in. And the S&P 500 is very popular, I think, around the world. It's just easy to see and identify. And then you go below that, and you start to kind of parse things up. The area that we invested in last week was clean energy, and that's done really well. And one of the things about clean energy that I like is that most of the ETFs have jumped over their 200-day moving average, which I think is a bullish sign. And then most of them have outperformed the VTI since the invasion of Ukraine, February 24th. For obvious reasons, there's going to be some money going towards clean energy as all of these countries around the world try to, diversify away from Russian oil and gas. And really, I think it's bringing home the fact that countries need their own energy source, right? And so the ways to get your own energy source is to have more clean energy, more wind and solar and geothermal and those type of things. And so that area, I think, is very hot. And I think will continue to do well. And it has this catalyst that is pushing it behind it. And it did fantastic in 2020, really good at the beginning of 2021. And all of those are down tremendously, mainly because they just got so far ahead of themselves.
Yep.
They're selling for 300 times revenue, don't even have earnings in some of these companies. And now that come down, 40 to 70% on most of those ETFs, and they're starting to turn back around. So it might not, we don't have big positions. Our biggest position is 6% and something like that, but most of the times it's around 4 or something, or less. Our more conservative portfolios, we don't do clean energy because it's a little too volatile. But that's an interesting area. The other area that we're seeing a lot of kind of buys pop up is just small cap in general. We're really seeing small cap kind of popping. It's not consistent, But there's a lot. We have a whole system that goes through and looks at all the ETFs every single day. We have a system that shows us became a buy that day. And so, we've seen healthcare popping. We saw clean energy popping. We've seen small cap moving also. So, those are things that seem, from an overall standpoint, fill out your total stock market index, fill out your S&P 500 allocation, and then maybe look at some of the subcategories that might be doing well right here. Small cap, healthcare. Healthcare is not moving massively quickly, and it isn't that high growth thing, but it can be a nice conservative, consistent winner in a market like this. And then small cap, is that kind of volatile piece, but certainly some exposure there would make some sense. Of course, VTI has exposure to small cap. It has exposure to healthcare. That's why I like it. I think it's important. I don't think people look at that enough. It is one of the biggest ETFs in existence now, that VTI, if not the biggest.
People really
it's right
love
up
it.
there. Yeah. And so anyway, and they should. 4.9% of ETFs beat VTI in a 1 year, 2 year, 6 months, and 3 months basis. That's pretty interesting info. Think about that. And so anyway, that's why we use it. All right. Well, that is the end of our show today. I want to thank everybody so much for coming today. Again, send in questions. We love to answer these. Hopefully, to help you move from where you are today to a better place. Help your retirement. Send them in to Ask Tom or Talk Money with Tom. Send them in all week long. We'll basically be able to have some time to work on them. If you want to look at what we have on the channel, feel free. We're working towards 1,000 videos now on the channel, over 90,000 views, and so subscribe, and I think it'll help you with your educational level about retirement. Hit the bell button to get notified when we put something new on there, and set up an appointment. If you're wanting to know how much you can spend today and not affect tomorrow, or whatever it is that you're looking at, book an appointment with Issa and I and get that process started. There's a book appointment button on our website. Click that and pick a 30-minute phone or video time, and we'll chat with you and see if we can help you. So, thank you very much. Looking forward to seeing you next week.